Hey, folks, thanks for joining me on another episode of the Quiet Light Podcast. Appreciate it. As always, this podcast is brought to you by Quiet Light Brokerage, where every entrepreneur on the team has turned into an advisor. First, they were entrepreneurs in the online world where they all built, bought, or sold their own online business, then joined the team as an advisor. And if you have not picked up a copy of the Exitpreneurs Playbook, please consider it. It's great for both buyers and sellers. And it's actually great for our next guest, as he told me after he read it. He is the head of operations for the U.S. for a company called Bean Ninja. His name is Wayne Richard, and he has shared Chapter 11 with a book. He downloaded it from exitpreneur.io. He's read the whole book, but downloaded Chapter 11 and shared it with his entire team to help them understand add backs so that they can better serve all of their clients in the e-commerce online world. So this particular podcast, we're going to talk a little bit about Wayne's background, which is fascinating. He's not your typical bookkeeper. He's a triathlete. He's a dad of 5. He thought he was having the third kid, and then they wound up with triplets, so it jumped to 5 pretty quickly. He always knew he was going to be an entrepreneur, but it took a while to get there. So he is an entrepreneur. He is head of operations for Bean Ninjas in the U.S. and serves online clients in the e-commerce world. Let's just jump to the intro, and here we go with Wayne. Wayne, welcome to the Quiet Light Podcast.
Thanks so much for having me, Joe.
Why don't you give us a little bit more background on yourself and what you do over there at Bean Ninjas?
Sure. A little bit about me. I'm partner and director of global operations at Bean Ninjas. We manage a global team and equip 7-figure e-commerce entrepreneurs with the financial tools they need to enjoy business success and lifestyle freedom. Bean Ninjas helps e-commerce businesses know through greater organization, grow through greater visibility and confidence, and better predict and plan their financials. I personally live out my lifestyle freedoms as a father to 5 kiddos, including triplets. And as a triathlete, I'm currently training for a half Ironman.
I was going to say the look here for the folks that are listening instead of watching, you don't look like a typical bookkeeper and accountant. Not that I don't mean to insult my friends that are bookkeepers and accountants, but you look healthy and fit and strong. Like I generally don't see, people think of bookkeepers as nerdy, I guess. Right. And I'm the nerdy one with the glasses on right now because my eyes are killing me because I'm getting old. But yeah, you don't quite fit the mold. So how did you land into this bookkeeping accounting role?
Sure. So it's funny you mentioned, I had a friend in a CrossFit class that we would do most mornings. He would call me the certified public assassin. And then, of course, that movie came out with Ben Affleck, the accountant. And it may have changed the perception, I hope, where now accounting can be sexy, if you will, and we can be fit. So maybe I'll be part of that change of dynamic.
There you go.
But as we were chatting a bit earlier, I didn't originally have an idea of being an accountant. There's a lot of education and training that goes into our profession. My interest throughout university and college was in sport. So I went to the University of Massachusetts, where I'd grown up, and went in with the intent to study sports management. And the first class you attend, they tell you about the career opportunities, but they tell you that they're really gloomy. You likely will graduate with a 4-year degree in debt with student loans and be offered a position where you may have to work for free or based 100% on commission of sales for something like season tickets, and will work very long hours and not have much of a lifestyle outside of that job. And balanced that out, I went to my next class, which was Accounting 101, and they introduced me to the idea that opportunities were limitless. Accountants are needed in every industry, every profession, every business, hospital, school, sports organization requires accountants. So I made my way right over to the administration building and changed my major to accounting. and spent my time then after college working in either finance or accounting for the last, 20 some odd years.
But now you're an entrepreneur. Let's
Right.
folks, I want people to understand that you're, running an entrepreneurial organization, and you have to think about all aspects of that. And you're not just a CPA or a bookkeeper. And I want people to understand that you are somebody that they can talk with and connect with. How did you make that leap as an entrepreneur? Were you always wanting to be an entrepreneur, starting your own business?
So it's funny because looking back, I was the boy that had the paper route and the guy trading baseball cards for sports games and trying to craft deals and bring in my younger brother to service a larger paper route, and paid him, we'd collectively pool our money and buy more video games. And I always had that interest. I think I fell into the traditional path that was shown to me in growing up in a very blue collar town. The route for those that could go on to further education was to get a good degree, work for a big company for your career, be taken care of through retirement. And I fell into that false sense of security. I came out of college, got a great job, a first offer, making a great sum of money, having worked $6.25 an hour work study jobs, checking IDs in weight rooms, to then making $50,000 in your first year while sharing an apartment with 5 of my best friends. It felt like I was wealthy. So, I didn't pursue anything entrepreneurial for quite a bit of time. And then you get into the demands of marriage and children, and I have 5 children.
You mean the pleasures. You mean the pleasures there, just as clarification.
And that's right.
Your wife might be listening.
The great joy, absolutely, and responsibility. So it wasn't until I was put in a position where I had to make a key decision. And it was a big pivotal moment for me, where my manager called and shared with me his gratitudes and what he felt was the best path forward for me and our organization. And that was to relocate my family to either Dallas, Detroit, or DC. I was aware, having been a manager responsible for laying off a large portion of my team, of what the severance offer had been for others. And I explored that. And they shared with me I could get the same offer where it provided me a tremendous runway to make a run of something on my own. And within my corporate career, at times that really were critical for me to have a side hustle, I was presented some interesting opportunities. My wife was in nursing school. We had 2 children at the time. And I was approached by a friend that asked if I could moonlight and provide some accounting and bookkeeping services in his small business. And at the time, he asked me to throw out a rate. And I threw a rate out there that to me seemed very high for the level of effort that I would provide. But he accepted. He's like, absolutely, that sounds great. And I was able to add value and get into his business and restructure some of the workflows that he was using to manage his bookkeeping and accounting and payroll processes. And it always sat with me as an idea. Wow, like if I could service one customer on 4 hours at this rate, well, 5 customers would replace my income. And I then had the opportunity. And, after discussion and some soul searching, but really some buy-in also with my wife. We had 5 children. I had always been the primary breadwinner in our household.
Did you have the triplets while you were in this transition period?
Yeah. So I launched a business with 5 children, 10-month-old triplets, a new home we had moved into 2 months prior, and a wife who had just graduated from nursing school. So wow. If my wife is listening, the critical moment was, really joining forces, and as a team, having that buy-in that this was something that we would work toward together. Oh, yeah. She sacrificed and she would pick up shifts at the hospital, working nights, leaving the family, all with a vision. As an accountant and having been very much involved in sport, I very much believe you need to have a vision of where you are looking to go. What are you looking to achieve?
Goals, and then, goals. Yes.
Absolutely. Because then you step into the baseline. Well, I want to get to here. Where am I today? Well, if I want to,
Are we talking about reverse engineering a path to those goals? My goodness, Wayne, we speak the same language.
you may have thought I've read the book. Uh, so here, it was just very much that. I've been involved in as a triathlete. The distance you need to get to, and the relative time you want to get there. So then you back into where am I in week one? So here it was kind of that commitment to my wife that, hey, after this many months, if I don't get here, then I'll go back to the traditional thing. I wasn't trying to burn the boats or, I really had that severance to say, if this severance runs out and I'm not earning at least, what enough to cover our fixed living expenses and provide a lifestyle somewhat comparable to what we had before, then I'll go back to a traditional route. But of course, as the story goes, and through what my father-in-law had shared with me early in my career, your success will be defined by the books you read and the people you meet. I was fortunate to meet some people during that time period that really provided me that courage, that visibility that this was something that was going to take off.
Yeah, it's great. It's our stories are not all that dissimilar, except that you had a lot more courage than I did, because I was single when I started my business. I had a 2-family with a rent in the front paid for the mortgage. So I was living debt free. I had some student loans and whatnot. But I didn't, and I didn't have that 32-week runway of income, but I had about $10,000 saved up. And I remember that first client that I negotiated a deal to do media buying for them. I was willing to accept something like $1,500. And I consulted my wife, and she said, "You are worth so much more. Ask for 3." And they didn't bat an eyelash and hired me for $3,000 a month. And that was the beginning of it. And it's very similar stories. I think having a strong supportive spouse or mentor in any way helps propel entrepreneurs to greater success with more balance in their life. But we could talk about ourselves all day long, and let's not do that, because what I really want to do here, based on the conversations we've had, is talk about some of what you've learned with being ninjas and working with entrepreneurs, and some of the common mistakes that they make when they're doing bookkeeping on their own or with an inexperienced bookkeeper. Before we jump to that, though, just say, what is the typical size of the client at Bean Ninjas, and who are they? Are they brick and mortar stores? Are they online stores? What are they?
Sure. So it varies in terms of size, but roughly we best support those that are in the mid 6 figures up as high as 25 million.
Okay.
That's just a handful. Tends to be e-commerce brands selling on Shopify and or Amazon or multi-channel. We've now begun to service more and more customers that are getting into retail locations like Walmart, Whole Foods, and have kind of a wholesale component to their business.
Are those the online folks that got big enough to get into big box stores, or they just started in big box stores?
It's unique brands, very trendy products that Walmart typically wouldn't have on the shelves. Whole Foods, similar, through success at Amazon, provides opportunity then for them to get on the shelves at Whole Foods.
Very cool. So you've seen a lot, people from doing $500,000 a year in revenue up to 25 million. I want to sort of hone in on what some of the common mistakes are that they make and how they can rectify themselves, those mistakes themselves, before, during, or after hiring a company like yours or any other bookkeeping firm. So if you could just start talking, what's the most common mistake you see people make when they're, I guess, doing their books on their own, which everybody knows I advocate for hiring an e-commerce bookkeeper, much cleaner books, much more successful, and you can focus on growing your business. But regardless, some of them still say, I can do that. And they become what? Jackies, right? Don't be a Jackie. Read the book. Don't be a Jackie. Don't say I can do that. You're not a teenager. Give us one of the most common mistakes that people make.
The most common, it's not the first, but the most common certainly is using spreadsheets or other manual processes instead of cloud accounting software. There's tools that are very affordable. Xero is our preferred cloud accounting solution, but also QuickBooks Online, where you can integrate, tie into your banking, automate bank rules, set up your accounting so that it's far more efficient, but provides for greater visibility and clarity into the financial reports that you would share to multiple audiences. The three most important: the tax man for everybody, regardless if you have interest to exit and sell your business. To you as the business operator, you need to have operational finance. And that comes through insights and data that's a reflection of those decisions you've made in your business through numbers that come about through these financial reports. And then you're very much aware to a broker. We're seeing more and more an interest.
You can just call it to a buyer. Doesn't have to be to a broker.
Absolutely. Yeah. We're seeing more and more interest from our sellers in not only, it's not exactly exiting, but understanding where their business may be valued so that they can make arrangements to create a higher value opportunity to exit at a certain period of time, or just have an awareness of where they stand.
Yeah. When it comes to spreadsheets, look, it's easy enough to start there. You're bootstrapping your business. You're just trying to keep the wheels on the bus and see if you've got something to operate, and you get a ballpark idea of your numbers. You're 6 months old. You're not exiting. That's okay. You still have to file taxes. Your life's going to be a lot easier when you go to file taxes if you just can provide your CPA with a real P&L, not a spreadsheet. Well, it's a funny thing because we say not spreadsheets, but what do we do when we export a profit and loss statement from QuickBooks to Xero? You put it in a spreadsheet, right? You save it to Excel. Right. But I've personally,
we do it in PDF so that there's no alteration.
Right. PDFs. That's good for the CPAs. I've sold businesses, folks. I think I talk about it, Bob, in the book. This gentleman his goal was to retire at the age of 50 and join the ministry. He'd been running a business, a side hustle, for about a decade, and wanted to sell the business. The business was going to be worth, call it $1 million. And he didn't have any bookkeeping. It was a napkin and a credit card and a bank statement. He built the P&Ls in Excel files on his own from the bank statements for 3 years. I told him to hire a bookkeeper. He wouldn't. We still went and listed the business, went under LOI twice, and it fell through twice. And the buyers couldn't put their finger on why it fell through. And my belief is it was because of the lack of confidence in the details and the numbers and running the business like a professional. He finally hired someone like you, Wayne, and they put it all into Xero, I think it was at the time, exported it to Excel. Lo and behold, the numbers are exactly the same, but it was done professionally by a bookkeeper. And we went to the backup buyers, switched it up a little bit, but ultimately ended up selling the business for about $50,000 more than the previous 2 LOIs. He got 20-time return on investment. I mean, it was a good investment to make, and his numbers were better. So if he had done that all along, he would have been able to analyze the reports that someone like yourself could provide and look at, let's say, I feel like I've told this story 100 times, but it's because I've been recording podcasts as a guest. But I was at a mastermind event where the coordinator, owner of the mastermind, got up on stage and talked about his own brand and how important it was to have good bookkeeping and numbers analysis. And this person did about $40 million a year in revenue. And, it was, a lot of it was recurring revenue. And he said, I noticed something a couple of months in a row with regard to freight charges. It was off. It felt like it was high. So we dug into it because we had the reports. They were giving us that little bit of a red flag. Mm-hmm. He said, if I hadn't caught that, it would have cost me about $1 million on an annual basis if he hadn't caught it. Now his numbers are so big, missing $1 million out of 40, maybe it's not that hard to find, right? Or it's hard to find. So I chatted with him afterwards, and this is where you and I understand things a little bit. Not only would he have lost $1 million in the process, right? But his business was worth about an 8-time multiple.
Wow.
So he's not losing $1 million, he's losing $8
8
million in
million.
the value of his business. And all because he was not using spreadsheets. He was using a good qualified e-commerce bookkeeper that gave him reports every month that he could analyze. And he was able to see that mistake. You can take that number and divide by 10, and it's still going to happen if you have the right details to pay attention to, and not an Excel spreadsheet that you put the numbers into yourself or somebody else does, but you're pulling in all the reports from your bank statements, from Amazon, from your Shopify store, all that good stuff. It's given to you on a silver platter on a monthly basis, which I think is great. So I'm
It does.
1,000% on board.
It creates the visibility and clarity. We see a lot of brands that come to us and they'll share with us their Shopify sales traction. Well, I go to the dashboard and I'm able to see my business is growing. But if they're not particularly aware of their contribution margin, their gross product margins, their customer acquisition cost, there may not be any fuel left for covering their wages and goals around what they hope to earn in the business. You actually alluded very nicely to transition. The next common mistake we see is failing to set aside time to do bookkeeping and review financial reports. We often see people that do have integrations into Xero. They did go about getting QuickBooks set up and linked into their bank, but they never run and look at the reports. What's critical is to take time to put like a date on your calendar, time to review the results that are generated from the activities from either your bookkeeper, whether you have someone on your staff, a VA, someone that's doing the categorization, the transaction processing, or an outsourced bookkeeper like our team at Bean Ninjas. But invest the time to review. It can be a quick call. It can be 15 minutes. Everything's on track. Numbers look great. When we look at the trends in line with our plan, things are amazing. Yeah. But that time also provides you that opportunity to have a bit of focused attention, to look into the trend lines, to look at, what I always ask is, do you like these numbers? If we don't like the numbers, then we need to make changes. And changes come about through operational decisions made, strategic decisions made in the business. Because all the numbers are a detailed account in numbers of the decisions you've made in the business. Mm-hmm. If you don't like how much you're spending on software and subscriptions, well, how long has it been since you've reviewed subscriptions to see if you have duplicate?
Oh, yeah. I see that all the time.
Absolutely. What are you paying for? Do you see value in continuing to pay for that service provider, that subscription? Did it make sense to go to that mastermind and bring the entire team?
No.
If so, then we justify and we say, yeah, we like these results. If not, well, let's work on some things we can change to drive different results in the future numbers.
Yeah, I think that's brilliant. The business that you're operating, folks that are listening or hoping to buy, is very likely your most valuable asset. So why in the world wouldn't you set aside 1 hour a month to be on a call with Wayne to review the numbers? Look at what it did for that person that I spoke about that almost lost $1 million. It would have cost him $8 in the sale of his business. Again, divide by 10, it's still an awfully big number. Before we jump on to one of the other common mistakes, Wayne, I want to go back to a term that you used, contribution margin. And I hear it thrown around a lot. I'm wondering if you could give the audience a simple, clear definition of what contribution margin is.
Okay, so in the point in which I referenced it, we as e-commerce specialists uniquely categorize expenditures across 4 major areas. So we lump together cost of sales, which are your product costs, fulfillment, merchant processing fees, to calculate your gross product margin. We then take away as the next major grouping customer acquisition cost to calculate a contribution margin after marketing. All that means is so if you had $100 and you spent $50 on cost of sales, your product fulfillment, you're left with $50. If you spend another $20 on customer acquisition, paid social, you're left with $30. That $30 is the margin or the fuel that's left to cover wages and team cost, which is our third category, and also operating expenses. Now, that gets you to different margins that we've coined: operating margin, that then allow for you to see your bottom line profit number. Now, what we hope to get to is building a business that allows for you to have significant enough margins to meet your desired spend in customer acquisition while leaving a budget available for you to take and earn a market-based salary at a minimum within your business based on the contributions, the blood, sweat, and tears that you've made to build something quite amazing that serves others. And then also profit at the end of the day. You want to have something, retained earnings, and ability to reinvest. And as we're aware in e-commerce, business is not built on profit alone, it's cash in the bank. So it tends to be that those profits then reflect as cash that you can then make those decisions on inventory, restock purchases, hiring, firing, launching new products.
And so in the cost of sales, if you're selling on a third-party platform like Amazon, that's included in the contribution margin numbers because it's cost of advertising in a sense, yeah?
Yeah.
Okay.
So it varies. Shopify will have a different chart of accounts than we will in Amazon business.
Okay.
It actually leads into, again, a common mistake we see: incomplete or inaccurate chart of accounts for their industry. So what we see is folks will use the template. Well, I plugged into QuickBooks. It has a template for retail, and I used that one. Well, the chart of accounts is a list of sales and expense categories that you reconcile or categorize your bank transactions into. But the biggest function of your chart of accounts is it helps build out the reports, your income statement, your balance sheet. So having a chart of accounts that's based in insights from your industry will allow for you to more easily capture key performance indicators that tend to be routinely asked when potential buyers are exploring your business, when bank or different lenders are making decisions on offering you capital through loans. So it's important for an e-commerce brand to look to an e-commerce specialist at a minimum for an idea of a chart of accounts that can best support bringing clarity and visibility into their financial reports.
And it's so nice to hear. I see all sorts of different chart of accounts. I've been doing this for a decade, probably reviewed 5,000 P&Ls during that time. I know I've had over 8,000 one-on-one conversations, and they're all different. They all look so vastly different. No two are alike. Even sometimes, obviously, when they're using the same firm like yours, the details of the business are different. Anything else jump out to you? I'm thinking of one common mistake, but that I see, that I used to see. I see less and less of it. But let's hear if you've got something else.
Yeah, so I do. So it's from the beginning. Most brands launch, and it becomes very difficult for you to fund the business without utilizing a personal credit card. And it may also be that you're utilizing and paying expenses from personal bank accounts for business purchases. It's okay if you have credit cards that have been opened in your personal name that are used for business transactions, but try to make that card exclusive to business transactions. Try not to merge in your daily Starbucks purchase with your software and subscriptions that are coming through to support your e-commerce brand. So we see a common mistake using personal bank accounts or credit cards for business purchases, and there not being a separation so that we can clearly get things organized to present the true profits that are coming through the business.
Yeah, that's called commingling, folks. And it's either when you do it with two entities and two different brands, or two different businesses and one QuickBooks account or one tax return, I should say. The daily Starbucks and whatnot, maybe you're writing it off as office supplies, which I guess is okay because you could, if it's delineated properly, you could still do it as an add back to make sure you don't lose that. And people are thinking, come on, an add back for a cup of coffee at Starbucks? Well, That's 35 bucks a
$300
week.
a month.
Exactly. That's a lot of dough.
Yeah,
That's a lot of dough. That's almost $4,000 a year on Starbucks times 4 times multiple. You just lost $16,000.
Yeah, that's assuming you're not buying for your team. Now, good entrepreneurs, you're gonna reward your team.
That's right.
So that's more than $6 a session.
Yeah,
and that's what's interesting. I do want to say thanks for writing the book, because you've provided to someone like me a new service offering. Right now, there's opportunity for e-commerce accountants to take that add back chapter of the book and say, "Wow, we understand how important financial reports are to creating clarity and visibility into a brand's numbers. We've talked already about planning, having a number you're working towards. Well, there's opportunity now for e-commerce accountants to build a templated report of trailing 12-month with the appropriate categorization in your chart of accounts of add backs, so that they can be clearly articulated in transactions set against bank rules to code them to the consistently, so that now the opportunity in the discussions with the customer is, wow, take a look at the traction that's been built over the last 12 months. When is it a good time to now explore reaching out and getting listed? The traction over 12 months, 16 months ago, might not look as favorable as today, based on that intent to make sure that the business is being run mindful of the end goal in mind of having a successful exit.
That's interesting. I hadn't thought that the book itself and chapter 11 in particular would benefit people indirectly, because, bookkeepers would be looking at it going, aha, okay, if I can just make some of these things a little clearer.
Maybe I just presented a new opportunity. I shared the chapter with my team. I downloaded the free chapter, shared it with my team, and said, I'd love for everybody to take a read through this, and we'll discuss it in our monthly call. That's because awesome. It is critical. One, I would say also, being someone that services dozens of brands, we do want to be consistent across the team, which it's not just Wayne Richard that's providing services to all of the Bean Ninjas customers. There is a team that's built behind us that helps support the effort. So to bring a common understanding that had been presented in a way that I had never seen. We had supported brands that had exited, and we'd supported and been in due diligence conversations and at the table. But the manner in which we now have within this playbook to create these templated reports, we can then easily share them across when a customer of ours presents the idea that, wow, it's in my 3-year plan to position to exit. We can then ask, wow, we have this tool, trailing 12-month income statement, appropriately recognized in the add backs across these major areas. They may not all apply, but let's have a conversation. Because if they do, or if you're interested in bringing in or spending money in a way that may not impact that price, you may be in a position to still get the benefit of the spend, but also not fear the penalty of the impact that it could create on a potential buyer's offer.
Yeah, to dumb that down, if you're launching a new product, at the very least break even on it. Because if you lose $5,000, you actually lost the 5 plus that times maybe 3 or 4. So you might have lost $20,000 to $25,000. It's really interesting getting that level of detail in the books, and the fact that chapter 11 would help e-commerce bookkeepers and all of their clients, because folks that are listening, y'all spend money in fourth quarter on things that you don't need to spend money on. They're not business oriented, right? The last time I reviewed a P&L, there was like $1,800 in December and nothing the rest of the year in office supplies. And it's because you bought a new laptop or a TV or whatever. And it was
or when back to school starts, office supplies.
Oh yeah. Absolutely.
Often
Absolutely.
the same time, businesses will restock inventory.
And you think, well, that's just a benefit. You're gonna reduce your tax burden, and that's good enough. But when you go to sell, it's going to cost you a lot more than you saved on your taxes if you can't identify it in QuickBooks, and you will forget, or zero, you will forget what that bump in that particular month was because you have so much going on and you're going to be overwhelmed drinking through a fire hose when you work with an advisor trying to drill down into all of this. So the more someone like Wayne can get that organized for you, the better off you're going to be, and the higher value you're going to have. Simply as that. No question about it. All right, Wayne, we're running a little long. We got time for one more golden nugget. What do you have for us?
I'll get pretty particular to either. I'll point this one toward Amazon sellers. One common mistake we routinely see is Amazon sellers recognizing income based on the net settlements from Amazon rather than the true sales figures that were generated in their business, and clearly are identifying the Amazon fees against those true sales numbers.
So let me just dumb that down a little bit. The people that you're talking to about or referring to are taking their deposits, what they're getting paid from Amazon, and counting it as total revenue.
That's
so
right.
You're back to what's contribution margin, Wayne? There's nothing in the contribution margin as far as Amazon fees go and advertising goes, because it's already out of that number. You're just putting in the deposit, which is bad because your buyers won't see what you're spending on Amazon advertising and things of that nature.
And you may also not have clarity into mistakes that Amazon may make. Or
they make mistakes?
Absolutely. I believe too, there's a prior podcast where there's some resources.
Get Tito, right? We just had him on. Eitan Wiener was on talking about how much inventory Amazon loses and how to get it back. Yeah. Well, that's great. I'm guilty. I did that myself, but I did it with when I was doing it on my own, my bookkeeping on my own, and I've grown up and I'm more mature, so I don't do that anymore. I have to talk the talk as well as walk the walk, or walk the walk as well as talk the talk. You know what I mean, folks? Where mine was, direct to consumer on my website, and I would just, it was only a 2.5% merchant fee, and so I just put in the 97.5% deposit instead of 100%, and then an extra line for the merchant fee. Because it was hard. For me, it was hard. I was doing it on my own, and it was a struggle, and I shouldn't have been doing it on my own. I should have paid, a nominal fee relative to what we spend on cars and boats and all sorts of things. Paying for your type of service is an incredible return on investment, in my opinion.
Absolutely. No, and I thank you again. The book read to me as a service provider as an amazing commercial to get out there and advocate for the services. We believe in the value of the service that we provide and really work toward building opportunities to create just greater visibility, really, in control over the numbers. As I alluded, you can get to the point. We see a mistake also too, that sellers know that things are bad, or brands will know the business financials are bad, and they don't want to know how bad. So they don't go into the exercise. But you can't make things better unless you have a plan and a clear decision point to make them better. Understand the baseline of where you're working from, and then taking and making some key assumptions on a path to achieve those goals. I
agree 100%. Folks, as you can tell from the conversation we've had, Wayne is not your typical bookkeeper, very relatable entrepreneur himself, and is just trying to help, right? Yes, he's running a service. Yes, he's running a business, but it's all with the goal in mind of helping you build a better, more valuable business for yourself and your family. Wayne, how do people reach you? How do they learn more about your company? Things of that nature.
You can simply go to beanninjas.com. There'll be all information available there. I'm on LinkedIn, so if they want to connect, if they have particular questions that they want to address, I'm always available to chat. And always, the greatest joy that I have is every day being able to spend time with entrepreneurs, hear the amazing stories of how they came about growing and scaling their businesses, but more particularly where there may be a pain point within their business that I'm uniquely fit to address and help them conquer.
Yeah, that's awesome. I appreciate your time. Thanks for coming on, Wayne.
Appreciate it. Thanks so much, Joe.